Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and it's the FOMC day today. Market participants have eagerly been waiting to see how Fed responds to the current set of updates for the US economy, along with the banking concerns already there. And talking about banking concerns, the international banking stocks took a beating yesterday, while the US job openings dipped to the lowest level since 2021. Basically, we have a cooling job market and a plunging short-term yield. Eurozone inflation accelerates slightly, but the core inflation softens, and we also had interest rate hike by the Reserve Bank of Australia. Uh, on the domestic front, the unemployment rate climbs to a 4-month high, while we continue to see on the other side as well as some of the macro updates are on the positive side. So there's a lot of many updates that we are seeing. So, DK, what are you observing and what are your expectations with these updates?
Hey, good morning, Shikhar. Yeah, I think yesterday was a day when bad news came thick and fast, and sentiment was souring with pace. And we had the risk negative news flowing almost throughout the day. Initially, market was trying still to discount after a long weekend to the Chinese PMI, which was lower than what was in March. Again, coming into contraction territory. But even as they were discounting it, we had the story about RBA raising interest rate by 25 basis points, completely taking market off guard. And they also left the door open for additional tightening. So this is something that the market was not expecting. And while Australian dollar rallied, but it was the interest rates or the yields that got pushed up after this. And in fact, this also gives credence to believe that even the New Zealand Central Bank might hike interest rate in the upcoming meeting. Then we had the Eurozone inflation number, which was comforting as far as the core inflation number was concerned. But the important point was that the bank credit data from in US in Europe actually showed a decline, and the lending standards had tightened and the lending quantum had actually declined at its fastest pace in 2008, and this was once again a very unexpected number. Possibly market was not paying much attention to this, and we have been saying that the impact of huge interest rate rise in Europe from negative 1% to near 4% has not really been shown up in the numbers so far, and that's what was seen yesterday. And this again led to European stocks actually falling well before the US markets opened. And then we had the JOLTS data, which was again definitely a jolt, because the number of jobs, new jobs available, fell by 389,000 compared to 146,000 fall that the market was expecting. So definitely a cooling in the jobs market, which the Fed would be happy to see. Of course, we should not forget that we had the employment cost index, which had risen to 1.2% compared to 1.1% as per the previous day's data. And while from Fed's point of view, this may be a good news, from economist's point of view, this was taken as an increasing the chances of a recession in the US. And in fact, the yield curve between the 3-month treasury bill and 10-year yield slumped, or rather yield curve steepened I went to the widest since 1981. So that is something that market is taking note of. And there is increasing evidence that the economy is slowing down on various counters, but we do have patches of good data as well. Therefore, it's not as though we are coming or have come to the tipping point as far as the Fed is concerned. In fact, we had the factory orders data, which was better than expected, and the orders were up by 0.9% compared to 1.1% decline that was seen the last month. Then adding to all this was even as the US markets opened, there were big declines in the regional US bank stocks, and most of them were down by 20%, and they were reacting to the failure of the First Republic Bank, which of course has been taken over by JP Morgan Chase. But then investors are worried that banks could start to show steep deposit flows, outflows, like First Republic, which is the third US major bank to collapse since March. So the impact on the market was very logical. Dow Jones, S&P 500, and Nasdaq, all of them dropped more than 1% during the day. European stocks were down 1.24%, and the overall global composite index of stocks were down nearly 0.9%. So we have been talking about the CBOE volatility index, VIX index, which is the cost that you pay for protecting yourselves against the stock volatility, which had hit 15.53 multi-month low, and now it has risen to 17.71, and this is reflecting a waning complacency in the market. Of course, in the background has been the debt ceiling debate, or rather the debt ceiling talks that has come to a hot debate now, with the Yellen indicating June 1st as the ex-date for extension of the debt limit, and also saying that the government would be unable by June 1 to meet all of its payment obligations without a legislation to raise the debt limit. Democrats have obviously started to put pressure on the Republicans, saying that they should not be playing playing with the economy for political ends. So now, just to give a perspective, it now costs more in the international market to insure a US Treasury bonds against default than it does for bonds of Portugal, Ireland, or Czech Republic. Let alone economies like Japan, Germany, Great Britain. So right now it costs about 2% to insure US Treasury bonds against default over the next 5 years. And that sounds pretty low, but it is up from 1.5% just at the start of the year. So debt ceiling talk definitely something that is going to get hotter and hotter in the coming days. Now on to the meetings, Fed and ECB. Fed obviously has I don't think, as far as inflation is concerned, they are seeing a much improved level from what they had seen. The headline has fallen, but the core inflation has remained sticky. Services inflation has not gone down much as well. So while the economy has shown a mixed picture, in my view, Fed, while hiking rate by 0.25%, which is almost fully discounted, even to announce a pause from here on, I think Fed would require more evidence both on inflation and the economy. Conditions are moving towards, where they would like economy to be seen, like, the jobs market contracting, and which would ultimately lead to, contraction in the demand and the price pressures. But I think Fed may remain non-committal as far as future rate prospects are concerned. They might sound dovish, but they will just refrain from using the word pause, and that is what is my opinion. So this can be taken as slightly a hawkish statement. So until market gets a message from the Fed that they're done with rate hikes, I think there will be a risk of sentiment as and when we get negative data about the economy as well. Then we'll also have the ECB meeting. Now that this loan data which we have got yesterday, it really ensures that the ECB's hike this month would be only 0.25% as against 0.5%, which many people were advocating. So we are now in a situation where credit conditions and monetary credit conditions are tightening. The economies are slowing down, and the inflation is still remaining sticky, but monetary policy is yet to take a real sustained pause. So really we are at a very big inflection point as far as the global monetary policy is concerned. As far as the Indian rupee is concerned, I think perhaps in view of the emerging risk sentiment, which is somewhat negative, we did see the mopping up of dollars by the central bank yesterday through major nationalist banks. And of course, this was also combined with outflows related to the recent IPOs. Rate was pushed above 81.90, which is closely watched resistance. But again, there were hordes of sellers there. So the dollar index, in fact, has reacted not so positively to the risk off sentiment which has been seen over the years. So perhaps this itself is an indication about the overall view on the dollar by the market players. So euro, which had slumped to 1.0940, has bounced back to 1.1030, and even the emerging market currencies are only marginally down. But then between Fed decision and his statements and how the economy evolves going forward, I think we will not see much of a strength in the emerging market, because there will be so much of uncertainty about the recession and how it impacts the other economies as well. So I think as far as the rupee is concerned specifically, the downside could be limited to 81.50 for some time to come, while above 82 we may still be seeing a lot of resistance due to selling interest. Thank you.
Okay, JK, that was quite good and detailed. I mean, yes, folks, we are at an inflection point when it comes to the global monetary policies, with a lot many major economies looking for signs to pause their rate hike regime. And talking about signs for rate hike regime or any other signs from the central banks, it is the US central bank which, as JK mentioned, may remain non-committal in their commentary, waiting for more data points to give any sort of further direction on the upcoming FOMCs in the coming days. On the ECB front, a hike may be contained at 25 basis point, because it's been observed that the credit is already declining and a natural tightening process is already in place, majorly because of the higher interest rates. On the Indian side, the Indian 10-year yields was at a 52-week low, and the dollar rupee action is also expected to remain in a range. So that's that for today, folks. We shall come back again tomorrow with another round of updates and the updates from the FOMC. That's it. Thank you so much for joining.